Good morning. Welcome to the HWB Budget Breakfast. Thank you all for turning up so early. Hope you all had lots of tea and coffee and uh, enjoyed your breakfast, and hopefully we'll be able to stimulate you with lots of exciting tax talk. So I'm joined today by all of our tax advisory team at HWB. Hopefully you can see me over this stand because I'm a little tiny bit short. So for those who don't know me, I'm Gemma Hedges. I'm the tax director at HWB. I'm joined today by Stephen Martin, our senior manager, Joe Wilson, our tax manager, and Alan Rolfe, our senior tax manager. Now, we all have our own favourite tax. I appreciate that's not what everybody does have, but we specialise in certain areas, but we also cover a very wide breadth of different taxes. So in theory, between us, we can cover all of the taxes that are relevant in the UK. So it's useful to have that team and to have all of us here today so that we can cover all of the exciting aspects that were in the budget. So we're going to talk for about an hour. Hope you're comfy, and hopefully it will be interesting. So the agenda for today is, first of all, a look at the economic outlook, and that's really how we got to where we are today. I think that's important because if you don't know how we got here, then you don't really understand the measures that she's put in place. So we can follow that with the measures that impact business taxes, and then the measures that impact personal taxes. And as I said, we're all specialists in different areas, so we're going to talk on our specialist subjects. So Alan and Joe are going to cover the business taxes, and then Stephen and I will cover the personal taxes afterwards. And Stephen's going to cover the first section on the economic outlook, because he's much more into politics than I am. So for those of you who didn't watch the budget yesterday, you will have missed a good telling off of the Chancellor for the fact that she goes to speak to her friends at the press before she speaks to her family in Parliament about all of the tax measures. And quite honestly, I hope that does change, because it does a lot of scaremongering of people before the budget comes out. There's a lot of panic, and quite often a lot of those provisions that are leaked are never actually in the budget. So it would be quite welcome if we didn't have that in future years. The other thing she got telling off about was obviously there was a small document that may have got leaked just slightly before the budget. And of course, when she stood up, it absolutely wasn't her fault. It was their fault. It was somebody else. But it all was just a little bit embarrassing, I think it's pretty fair to say. And then there was the usual heckling, as there always is. But for me personally, there was a lot of fear going into the budget, because October 24 was a bit of a horrible one for me. There was a big curveball in the form of the inheritance tax. No one was really expecting that. So actually, we weren't really sure what was coming in the budget this year. And what did actually come was not really anything really major. There's a lot of little tweaks and a lot of little bits here and there, a few adjustments, but actually nothing that obviously is going to fill that huge black hole. Definitely nothing that seems to be likely to fill it in the short term. But I'll leave you to have a look as we go through the different provisions and see if you agree with that statement or whether you think she did a good job. Everyone's opinion is different. So I will hand over to Stephen to kick off on the economic outlook. Sorry.
Good morning. So I think we need to start kind of with Nader coming to office. So she came into office with a huge fiscal black hole. So we had a one-time budget in October that made some substantial changes to employers' NICs and rehab business. So employer NICs up to 15% with a reducing the allowance staff. She increased the rates of capital gains tax, and we've got a really low £3,000 annual exemption. Just so headline increases in tax in the October 24 budget. She makes some substantial changes to the way inheritance tax works for new business, which are very harsh, but deferred until April 26, so not immediately raising in tax. She also brought pensions into the scope for inheritance tax for the first time, which is a huge change. But again, that done actually in April 27. So in total, that budget raised around £44 billion in tax increases. At the time, she said it was a one and done, and she would be coming back for more taxes or more borrowing. Off the back of that, we've got really slow GDP growth. So in the last quarter, it's 0.01%. So there was nothing really in the October 24 budget to stimulate growth or get the economy going. the speculation, as Gemma alluded to, in the build-up to this budget, really gone through the economy as well. The issues with Jaguar Land Rover, I think, had a 0.2% impact on GDP. So that is why GDP, did increase and slightly 0.01%, but effectively since Labour obtained office, it's been flat. On the back of that, we've got really the kind of sticky inflation. So when Labour took office, inflation was at 2.5%. It's now stuck just at around 4%. So it's down to 3.9% in the last publication of the stats. But that impacts kind of how people feel day to day. So the prices are going up, cost of business are increasing all the time. She really struggled to get inflation down. The flip side of that is the Bank of England base rate hasn't come down as quickly as she expected because of inflation being so high. So it's still at 4%. It is expected to potentially decrease by a point in the next announcement in December. Whether or not that actually happens off back this budget remains to be seen. So off the back of that, she's had to come back with this budget, and we just had with another £26 billion of tax rises. So that puts £70 billion over two budgets, with nothing really in the budget to boost the economy or stimulate growth. But this slide kind of shows that although she come back for an additional £26 billion in this budget, they don't really bite until the 29-30 tax year. So, so we're here at the moment. She's announced these tax increases, another 26 billion. We're during the general election around here. So whether or not these actually get implemented is kind of a big political question. Is this thing when we're campaigning into that next election, who's going to want to give us these horrific tax increases? I would point out kind of the blue line here is the changes to salary sacrifice and the increase in national insurance. And these big black lines here are the stealth taxes, fiscal drag, the freezing of the rates. So they don't really bite until after that general election. So she's really hoping that people feel better by the time that election's coming and they see the improvement in public services. So the spending's happening now, but the tax increases aren't actually happening until the future. So how do generally then talk about what we'd hope to see?
Yeah. So when Stephen and I were talking about what we wanted to be in the budget, I said that I wanted it to just be a little bit more simple because although it sounds like I'm doing myself out of a job, when I started in tax, it was still hard. There were a lot of measures, but it wasn't as complicated as it is now. And every year they say they want to make it simpler. They want everyone to understand what tax they're paying. And I think we should understand what tax we're paying because we are all paying it. But actually, what this chart shows is how many tax measures are brought in per year. I know the font's quite small, but you can see that from 1970 to 1992, we're looking at less than 20 measures a year. And that's consistent all the way through. And then as we've got further along, it's got more and more and more. 2024 is just under 160 new measures just in 1 year. And that's when it becomes very difficult to manage, difficult to understand. And it gets to a point where you almost need to come and see your tax advisor every year because everything you were told last year has changed. And then it changes again the next year and it changes again. And that can be really difficult to plan things effectively. It can be really difficult to know what to do. And you might make some decisions that actually within a few months were already potentially the wrong decision for a tax perspective. And that's really not what she wants if she wants to drive growth. So simplicity would be much better. There is an obvious drop in there. Nobody did anything in 2020, including tax, so that explains that one. So now we've gone through what the economic outlook was, how we've got to where we are now. We'll cover what we're looking at going forward, and I'll pass over to Joe and Alan to cover this bit.
Up to you. Good morning. The first thing we're going to look at is business taxes, and the announcement yesterday, here we go, is corporation tax. And the Chancellor confirmed in the budget on Wednesday that the main rate of corporation tax will remain frozen at 25%. You may remember a few years ago, this went up from 19% to 25%, but for the duration of this parliament, the main rate of corporation tax will remain at 25%, and the Chancellor did boast that this gives the UK one of the, I think, most competitive corporation tax rate in the G7. Just by way of reminder, if a company has profit between 50,000 and 250,000, they get marginal relief on that corporation tax bill. And if if profits are under 50,000, then the corporation tax rate is a historic 19%. So not much change there, but we do know for certainty that it is going to remain this rate until for the duration of this parliament. The budget did, though, announce some changes regarding capital allowances. So just a quick recap. Capital allowances allow businesses to claim tax relief on expenditure on capital items. So things like plant and machinery, it's things like integral features, things like cars. And it can be a very useful mechanism to produce taxable trading profits. But in this day and age, we now see businesses can almost get upfront 100% tax relief in capital allowances. This is because all businesses have an annual investment allowance of 1 million available to them for every 12 months, which allows them to claim full tax relief on purchase. And in addition, if any expenditure falls outside the annual investment allowance, there's full expensing available, which allows another 100% tax relief to be available, with some exceptions. However, historic expenditure or expenditure doesn't fall within these limits would not get 100% tax relief, but would get a writing down allowance. So currently, the writing down allowance for main pool items is 18% per annum. But the Chancellor announced that from next April, this writing down allowance will go down by 4% to 14% per annum. So whilst tax is not being lost in the long term for businesses, whether they're incorporated or not, it will take longer to obtain the total tax relief. So if you had historic expenditure that you incurred whilst annual investment allowance was not so generous, that's been slowly written down, or for whatever reason let's say you bought a car which isn't covered by annual investment allowance or full expensing, it's going to take you longer to obtain a tax relief that was previously available. In addition to the above, the Chancellor made a lot of fanfare about this new 40% first year allowance, but it's not actually, we've been discussing it, it's not going to actually have much of an effect, because it's only going to be a benefit to a business where they use the 1 million annual investment allowance, and that's not enough. But if that's not enough, the expenditure gets covered by full expensing, which is 100% release. So why would you choose it? So it's only going to really be an advantage to unincorporated businesses that have spent over 1 million on capital expenditure, because unincorporated businesses can't get the annual investment allowance, or companies that are involved in leasing. So yes, it's there, it's out there, but don't get too excited about it, because there's far more generous reliefs there. And I think in most cases, we're not going to see it apply to our clients, as we were discussing when this was announced. Just to note on this first year allowance as well that's introduced, it's not available on cars, just like the annual investment allowance and the full expensing, and it's not available on second-hand purchases as well. So that's just something to bear in mind. I just wish to mention R&D tax changes, R&D tax relief. Now, that's something you do quite a bit at HWB. And you may be aware in the accounting press that HMRC have really gone after R&D claims, because there is a lot of fraud in this area with spurious claims. And as well as increasing the filing requirements, the admin burden, the risk of inquiry, HMRC have made this relief a lot less appealing to companies. So typically for companies with a 12-month accounting period ending March 2025 onwards, they will typically not benefit from the generous SME scheme that's available for smaller companies or medium-sized enterprises. Instead, we have one new merge scheme that applies to all companies that do R&D unless they're R&D intensive. So in short, the new scheme offers 15 pence tax saving on average for every pound of R&D expenditure, Whereas under the old scheme, SME, if you were doing a claim for the period ending March 24, the average saving was 21.5p. So if we're thinking we're getting like a more than a quarter drop in the tax saving there, plus you got to do 2 more forms than you used to have to, the risk of inquiry is higher. I think if you are, as a business, looking to do R&D, yes, still go for it, but let's quantify what the potential saving is, because the admin burden could very quickly outweigh the saving that's available to you. So that's something to bear in mind. The next point I want to talk about is probably one of the biggest things that came out of the budget, is the rate of national insurance. And the rate of national insurance paid by an employer on employees' earnings remains frozen at 15%. And by way of a reminder, this is payable on each staff member that earns over £5,000. So historically, we typically see directors award themselves a salary of up to 12,000, and it was brilliant. So they got full corporation tax relief, and the employer or employee didn't pay any national insurance or very little. But in the previous budget, that changed, and so that if a company director wants to pay themselves a low salary to get a qualifying year for state pension purposes, the company will at least have a minimum NIC bill of £225. I also want to say on this matter, with the government announcing the increases in minimum wage, an employer is only going to see their NIC bill go up. And so if you think it's 15% on all contributions, it's going to be quite significant. I would point out that businesses with more than one staff member can still benefit from the NIC employment allowance, with £10,500, which can be offset against your total NIC bill. But I think that the announcement that got the biggest attention was that from April 2029, a long time away, each employee will now only be able to sacrifice £2,000 of earnings in order to get full tax relief and NIC relief on their salary payments. But this change isn't going to come into April 2029. As Stephen alluded to earlier, we could see this could be changed as part of a party's election manifesto. So it'd be interesting to see how that works out. But what it is going to say is that it will cause quite a dent in an employer's NIC bill. So if we think about it, contributions over £2,000 in salary sacrifice are now subject to will be subject to April 29, to employees and employers' NIC, but crucially, they'll still be free of income tax. And the easiest way we can demonstrate this is for an example. So if we have an employee on an annual salary of £65,000 who gives up £5,000 of salary to the pensions, they pay no tax, and the employee and the employer pays no NIC on that £5,000 given up. But from April 29, NIC will be charged at £3,000, and if the rates remain constant, the employee will have an NIC charge of £60, so damage isn't too significant. But where the damage is felt is that the employer will have a charge of £450. So if there's a number of employees, that's going to be quite expensive, because you think the NIC employer's rate is 15% on that salary given up, and 3,000 at 15% in the example given is £450. Finally, on this topic, the government gave some announcements that they have announced funding for apprenticeships for under 25s, and now for SME businesses who fund apprenticeships, the costs will be fully funded by the government, whereas I think previously businesses had to meet 5% of this cost. More details to be announced, but the government did, I think, make a bit of a fanfare about this is one of the new things they're going to introduce. So it will be a bit cheaper now for businesses to train apprentices who are under the age of 25. So Hannah's going to talk now about VAT or business rates.
Thank you. Yeah, I know Joe wanted to get to the VAT. I saw you skipping ahead trying to get to this part. So VAT was an area that there was a lot of talk before the budget that there were going to be changes. In particular, the playing field isn't considered to be very level because a lot of smaller traders are below the £90,000 registration threshold. So they're not charging VAT on their supplies. The thought was that they would bring that threshold down. Across Europe, that's a very high threshold. Many European countries are 35,000 euros registration threshold. So a lot more people are VAT registered. This sort of imbalance, though, wasn't addressed, probably because they didn't want to risk the possible damage to the economy that suddenly bringing more traders into the VAT net might cause. So we've been in the situation where everybody's kind of expecting a change, but nothing happened. The VAT rate obviously didn't change because they promised that in their manifesto, so we weren't surprised that that didn't happen. There were hopes, though, for simplification. There's always fuss about food. There could have been some tidying up there. And property as well was an area where at the moment we have exempt supplies, standard rated supplies, reduced rate. That again was something that from a simplification point of view, we would have hoped to see some action. Nothing at all on any of that. So where does that lead us? Well, I've got there about private hire taxis. So this is the likes of Uber and things like that. And you'd think, this is not important, is it? At the moment, Uber is relying on TOMS, the tour operators margin scheme, because as you know, when you go in a taxi, it's like going on holiday, isn't it? So they've managed to work out that you can apply the tour operators margin scheme to taxi fares. And as a result, the revenue are not too happy about that. There's currently nearly £1.5 billion at stake in an appeal that's going to be heard next year. In the meantime, the revenue have lost patience, and in this budget, we've got a measure that removes the ability for TOMS to be used by the likes of Uber. So it's covering London principal suppliers, but anybody with a national presence like that. The critical point here is going to be establishing who's the principal in the supply. In other words, when you book a taxi, do you think it's Uber or do you think it's Fred who's actually driving the taxi for you? Uber is kind of playing the game where they started off by saying, oh, when you book an Uber with us, you're not booking with us, you're booking with Fred who comes and drives you. Well, they lost that case on an employment law basis, so then they've been forced to use TOMS. The revenue have now closed that window. As part of this, we're also expecting changes to do with property because there's a certain element of Airbnb type lettings where a single property is rented in for a longer period and then rented out in shorter bursts. This is the rent-to-rent world. TOMS applies to that as well, very helpfully to reduce the VAT bill for those type of scenarios. At the moment, there's a lead case that is going through the courts, and therefore we didn't get to hear any more about this. We expect some action on this because, again, probably quite a lot of VAT is being hemorrhaged in this world. We're certainly talking hundreds of millions, possibly billions there. So again, if that case doesn't go to the revenue's way, then I would really expect the revenue to act as bad losers that they always do and change the law. So we can expect some changes there. Indeed, TOMS may even be scrapped altogether because it was a simplification measure, particularly to do with Europe. Because if you're a travel agent and you're booking a package of holidays, it avoided you incurring VAT registrations across all the destinations you were supplying holidays. Now the UK is not part of Europe for VAT purposes anymore. The logic of having it is perhaps a little bit lost. So we'll see what happens there. On the context of Europe, electronic invoicing is quite widely coming in now across Europe. Many countries have started. And what this means is not sending a PDF of your invoice to your customers. It's an actual electronic exchange of underlying data. And it will go through some form of network. The revenue are keen to do this. This is sort of expands their making tax digital for VAT because it will hopefully, from their eyes, allow them to trace a bit more what's happening in the economy in more real time. The electronic invoicing is coming in from April 29, but it's time to start thinking about it. The revenue haven't said how this is going to work. It will be subject to a consultation. It seems as if there are many possible electronic formats available. So they may give us a bit of flexibility, but it's definitely something to start thinking about. And if your VAT invoicing software doesn't include this, and you've got to make any decisions about contracts for VAT software, you might want to think about the future, because this will come in. I don't think any, sort of election changes will derail this. This is definitely on the cards. One feature that may then follow, once we've established some electronic invoicing, is that we're trying to cut, or the revenue are keen, and the Chancellor's keen to cut fraud out of the economy. And VAT typically loses quite a few billion. People don't pay it. People collect the VAT and then disappear off, fraudulently not paying it over to the revenue. What electronic invoicing might facilitate is a greater use of a reverse charge. So we may well see businesses not passing the VAT along the supply chain, and it's only the end consumer's VAT that is payable to the revenue. We'll wait and see. That's a longer term objective, I think, here. On a more practical level, we've had a few other little small changes. Low value imports have been targeted now. What this is there's a customs duty relief for imports of less than £135. So what you'll be seeing is retailers like Temu, Shein, those sort of clothing companies, where they sell the clothes directly to the consumer and import them in one hop. That is giving an unfair advantage to those type of overseas online sellers. So that duty that they're skipping by not accounting for it, because it's not coming to their UK warehouse, because it's going direct to the consumer, is now going to be targeted. The date for that is March 29, but I wouldn't be surprised if they accelerate it, because this is something that Europe has also taken action over. So I think they won't feel under pressure that the UK will become uncompetitive by introducing it sooner. Charitable donations is an area that they mentioned in there. So when a business gives goods to a charity, it's a deemed supply. You have to account for VAT on it, so that makes it less efficient. They're going to give a relief for it. The budget documentation wasn't very comprehensive on this, but I've seen it commented that this may cover goods of up to £100. So it's not a huge value available there, but we'll wait and see for the detail. There may be a slight expansion of that, but it's useful anyway, and that's coming relatively soon, next April. So if you've got a plan to donate some goods to charity, maybe it's worth waiting until April, because that might save a bit of VAT and allow more generous donations. And finally, there was a veiled threat of higher late payment penalties for VAT coming in April 27. Now, they've just relatively recently, 2024, changed the VAT penalty regime, and they put in some fairly nasty penalties with that for late payment. They then increased it. We now have a late payment penalty for VAT of at least 10% if you're significantly late, like more than a month, etc. I don't think they really need to increase the penalties any further, so I'll be very concerned that they're planning to increase it still further beyond what we've already got. But so we'll just wait and see. Watch this space for that one. My glamorous assistant will move me on. Yeah, thank you. I'd now like to just briefly talk about business rates. Not usually something we would talk a lot about. We've got a revaluation of property coming in April. As a result of that, the standard rate that will apply is going to slightly reduce. So potentially business rates will be more affordable. However, of course, you've got to weigh that against any increase in valuation. So we may be broadly neutral. the theme of the Chancellor's budget was support of the high street. So they've introduced a reduced rate coming in April alongside the revaluation for retail, hospitality and leisure businesses. Small businesses get a 38p rate and the standard one is 43. So those are 5p cheaper than the standard rateable value that's used for high street properties. To fund that, the message was, oh, we're going to tax Amazon and their large warehouses. So anything with a rateable value over £500,000 will be paying a higher rateable value, an extra 2.8p from April. The change from that's happening here means that they've decided they will give some support. There's a revaluation support package going to be announced for businesses where their rateable value moves a lot. That's available to larger businesses, and for small businesses losing support that they had previously as a small business and where they don't qualify as a retail, hospitality or leisure business, there's going to be an extra package of measures for them. So the picture, though, is marketed as, oh, we're going to save a lot of rates, but in the detail, it seems that only half the businesses will be paying less, and that means half are paying more. So flip the coin. Are you feeling lucky? Now I'll move back to Joe to talk about cars.
Yeah, so in the budgets, there are quite a few announcements about cars, and some of them actually went under the radar, so hopefully we'll cover all the main points here. The first thing I want to talk about is the grant for buying cars, because the Treasury announced a further 1.3 billion in electric car grants. So this will offer a discount of up to £3,750 on a new electrical vehicle purchase for £37,000. There is a second band of £1,750 for other qualifying electric vehicles that are not deemed to be as sustainably produced as the other electric vehicles. We don't know the criteria yet, but we'll see how that works. The scheme was in place, I think, designed to be in place to 2028, but it has now been extended to 2030. Now, what I do want to focus on, and which I think has gone under the radar, is that businesses, whether they're unincorporated or incorporated, will still be able to get 100% first-year allowances if they buy a brand new electric car. Now, this was provisionally in place until March 2026, and it has been extended again to March 2027. So if a company purchases a brand new electric car for £60,000, it will be able to deduct up to £15,000 against its tax bill because it gets full tax relief in the year of purchase. Contrast that with other cars, such as on either a hybrid or a standard car, then there's no full tax relief on your purchase. It doesn't qualify under the AIA or full expensing that I mentioned earlier. It would only get writing down allowances of now 14% or 6%. So electric cars are very valuable still to a business. And crucially, I don't think the government made enough of this. They have extended the time in which an electric car can be bought and get full tax relief. But I would point out that there has been this understanding in this area. This generous tax relief is only available to fully electric vehicles, not hybrids, and the vehicle must be a brand new electric car. So if you buy a second-hand electric car, you will not be able to get 100% first-year allowance. Instead, you will get the writing down allowance of what is now 14% per annum. So yes, but you'll get tax relief, but it'll be a lot slower than compared to buying a brand new electric car. Now, what are the other big benefits of electric cars to businesses, as well as the upfront corporation tax or income tax relief? Is that if they are company cars for their staff or directors, then the benefit in kind is significantly lower at the moment compared to other cars. So currently, the benefit in kind on a pure electric vehicle is 3% of a vehicle list price per annum. Whereas, say, for a vehicle with a CO2 rate of 51 grams per kilometre, the percentage applied is 16%. So we're looking at a benefit of over 4 times the value. Now, although these are generous benefits, I would point out that the percentages used for electric car vehicles assessing the value of the benefit aren't going to be increasing. They're going to be increasing by 1% over the next couple of years and 2% for the following years after that. This means that by the 2030 tax year, the benefit in kind rate applied to an electric car will be 9% of the list price. So that is still significantly lower than other cars, but it is almost like a threefold increase in the value of the benefit in kind compared to what we're receiving today. From April 2028, you may have seen this as well in the budget, the Chancellor announced that electric cars will now be subject to a mileage-based charge, which will be 3p per mile. Now, so if an electric car driver does 10,000 miles in a year, they're going to face an annual charge of 300 quid. But how do they expect to assess it? Well, I think it's meant to be self-assessed. Drivers will be expected to self-report their mileage, and they're meant to pay up front through direct debit. I don't know how it's going to work, but it could be an absolute mess, but we'll see. Now, the mileage checked annually for an MOT. And someone actually asked the Chancellor, what happens for new cars which don't have MOTs? And I think she was a bit perplexed. She didn't know the answer. But apparently I think what the government guidance is at the moment is there'll just be an annual check. We don't know how that'll look through. And I don't think the Chancellor knows either yet, but watch this space. So just be aware of that small supplements coming. You may be aware as well that there's something called the expensive car supplement, and it's known as a luxury car tax. And the current threshold for that is £40,000. And currently, any vehicle costing more than £40,000 pays an extra tax charge of £425 per annum, rising to £440 next year. But that threshold is increasing to £50,000 for the expensive car tax charge, but only for pure electric vehicles. Hybrid cars or other types of cars will still have the threshold that was in place at the moment of £40,000. So we're only seeing a threshold increase for electric cars. So a lot to consider there. Some things that have slipped under the radar, but we'll see how this gets implemented and administrated, because I don't think anyone actually knows yet at government. So watch this space. So now back over to Jenna and see who are going to talk about more personal facts issues.
So we're going to kick this off with the big one for personal taxes. Sorry. Keep the short one behind the lectern. Income tax, obviously the big one, obviously impacts all of us. This one was a little strange in that her policy was that we're not investing enough in the UK. We need to invest more, and that's what's going to help grow the economy. But property income, savings income, dividend income is all arguably income from investments, but she's going to tax that higher. So a little bit of a mixed message there, and it's also not consistent. So she's putting a 2% increase on the property income and the savings in all of the tax rate bands, so basic rate, higher rate and additional rate. But she's not doing the same for dividends. So it's going up in the basic rate and the higher rate, but not in the additional rate. So what that means is the higher rate of dividends will be now at 35.75. The additional rate for those over 100,000 of income will be at 39.35. So the gap there is smaller, and it looks like she's incentivizing people who are on those high dividend incomes, presumably because she thinks that the people that are going to be investing, or she wants investing, are in those income brackets. But it's also a really good planning mechanism for us, because actually what's happening is that the rates between dividends and property income, savings income, employment income are widening. So then there's more that we can do when we're looking at profit extractions from companies. One thing that was bandied around a lot before the budget was that she was going to put national insurance on property income. Everyone was quite fearful of that. She didn't do that in theory, but actually in practice she sort of did, because national insurance rates are 8% in the basic rate band and they're 2% in the higher rate band. So that 2% that's gone on to the property income is effectively like putting a national insurance, but she's also put it on the basic rate band as well, and the higher rate. And she's also put it on savings income. So no, she didn't bring in national insurance on those income sources, but she actually effectively did in terms of what she's taxing. So what this means in practice is that if you have employment income and you're a higher rate taxpayer, you pay 40% income tax, 2% national insurance. If you have property income, you're paying 42%. Savings income, 42%. So we've now leveled the playing field between those. Although, if you are doing your CTA exams soon, like us and our trainees are, this is going to be a horrible calculation in there with all the different lines. The other thing she did, which was a little harsh, and that we usually can make our deductions against the most taxable income. So if your property income is the highest rate of tax and your dividend income's lower, you'd claim your deductions against the property income. So you're saving your tax at 45%. She's now switched that on its head. So you now have to claim your deductions against the lowest rates of tax. So your deductions are going to go against your dividend income now rather than your property income. So it's another way where it doesn't sound, when you look at it in the document, it doesn't sound like a big deal, but actually it's going to cost people more tax in quite a sly way, in my personal opinion.
So here we're just going to look at kind of a few of the impacts of the freezing of the income tax bans. So what the graph's showing here is the red line is the higher rate band threshold, tracked back to 1980, and the blue line is what that would, the equivalent of that in real terms cash today. So back in 1980, you would have needed earnings in excess of £100,000 to be paying high rate tax. Over time, the value of that, so kind of the stealth tax has been happening for a long time. So more and more people over time have been brought into high rate tax. But we're going to see that now with the freezing of thresholds again on steroids. So the blue dotted line is if we track the value in real terms today of the high rate band adjusted for inflation at 2%. So if inflation continues at a higher rate, the value of the higher rate band continues on a much steeper trajectory down. So as I say, it has been happening a long time. Currently about 13% of employed people or income taxpayers are in the higher rate band. Every year that these bands are frozen, around 1 million more people are going to get pulled into higher rate band. So by the end of this parliament, they suggest that a quarter of all taxpayers will be paying higher rate tax. So people are really going to start to build this. And if we look at the value of the personal allowance, that's the red line. So that's the personal allowance. This is tracked back to 2000. We've got the dark blue line at the top is average mean earnings. So the gap between the red line and the blue line is where you pay tax. So you can see as a result of the freezing of the thresholds, the two lines kind of increase. So the gap gets wider, and that's the gap where basic rate payers or high rate payers are paying tax. So again, the kind of the dotted lines project forward at a 2% rate of inflation. If inflation continues at a higher rate and average mean earnings, if you like, keep up with inflation, that gap gets bigger and bigger. And that in one of the early slides is the big black line of where the government are going to be collecting this additional tax. So the impact of these frozen allowances, again, is about 800,000 more people are brought into the scope of into tax, where their earnings or income would be below the red line. They're going to get calls above it. The dotted line is the new state pension. So because we know the triple not staying, you will see that the value of the full new state pension exceeds the personal allowance in April 27, which is going to cause potentially a few problems. So the basic state pension is going to increase by 4.8%. In her statement to the House on Wednesday, she said that those pensioners won't have to pay that income tax. But when you read the Red Book policy document, it actually says they're looking at a mechanism to collect that tax from pensioners without them having to physically make a payment. But then she did say on TV last night as well, she's not going to collect the tax. So I'm not 100% sure she's actually read her own budget. So we don't know how that's going to work, whether or not state pension is going to be subject to PAYE or something similar to collect the tax. So as a result of the change in the rates of dividend tax, owner businesses or people that can choose how they extract money from their business need to look at the models of how they're extracting their profits. So the effective rate, so if we look at a company that's paying the main rate corporation tax and the shareholder is a higher rate taxpayer already, if they want to take out a dividend or additional money, cash or bonus, what's the most effective rate? So currently, the effective rate of tax on a dividend is just over 50%, and on a salary, it's just over 48%. As a result of these increases to the rate of dividends, the effective rate on the dividend is going to move to just over 51 or just under 52%, whereas a bonus will remain at 48, just over 48%. So everyone that does have the option to kind of tweak how they extract cash from their business needs to look at those models, and kind of every scenario is going to be different. So typically it's going to be a mix of salary, pension contributions, dividends, and probably an electric car. But everyone's going to have to go back, revisit those models to make sure you're extracting the value from your business kind of in the most tax efficient way.
Thank you. So one of the things that was notable in its absence was making tax digital. It's quite an exciting topic in our office because obviously it's a big deal for our clients. But actually, she didn't mention it in her budget speech, and there is very little on it in the budget documents either. In fact, they say that they're going to exempt one small group of taxpayers. Can't say which ones. They also say that the start date for some others are going to be deferred until April 2027. But again, they don't say which ones. So as it stands at the moment, we've got the same rules as we had before. So from April 2026, we've got those with turnover and definitely not profits in excess of 50,000 from rental or from self-employment that are coming in from April 2026. They'll have to do making tax digital. And then from April 27, the ones that have got turnover from rental or self-employment again of 30,000 or more will be within making tax digital. So it's coming, it's getting closer and closer. Still don't have adequate guidance, not adequate software either. It's one which we were really hoping they'd push back, but they have pushed it back a lot. And I think they were getting to the point where they feel like I couldn't push it back any further because it would lose trust in the government, which is obviously not ideal. They did say, though, that they'll have a soft landing in terms of the penalties. So they won't create any penalties in the first year if you don't file your documents properly, which seems fair, seeing as everything's not ready for them anyway. So it's a nice concession, but I think it's a necessary one. One of the surprising things they brought in was a removal of this home working allowance. So for anyone who's claimed this, it's at £6 a week. It's not going to set the world alight, but it's something that you could claim for working from home. You didn't have to justify it. You just had to work from home and say you did and claim this allowance. Obviously, a lot of people did in COVID. So then they said, well, actually, your contract now has to say that you work from home to be able to claim this allowance. And obviously, they think they're still losing a lot of money from it. So now they're saying, well, we will still reimburse expenses, but you need to justify them. So now it's not a straight, this is your allowance. You have to now justify what expenses you incurred and get those reimbursed from your employer. It's £312 a year. Like I say, it's not going to set the world alight, but it's something I think they're having a bit of a tidy up of, I think it's fair to say. So there's a lot about encouraging investment, tackling underinvestment in the UK is how she worded it. So to that end and means, she then increased the investment in EIS and VCT. So you can now invest 10 million. It's obviously aimed at the bigger investors and not really the man on the street. But she also decreased the income tax relief for VCTs. So they are now not on a level playing field with EIS because they still get the 30% income tax relief. VCTs now get 20% income tax relief. Obviously, when we see tax changes, that does drive behaviour. So the likelihood is more people will invest in EIS rather than VCT. And I strongly suspect the VCT market will have a lot to say about that unfairness. But essentially, this is all under that scope of we want the UK to be the country to scale up your business in, to stay in, to grow your business in. This is all around that aspect. But she has continued it as well for more of the man on the street. So again, a lot of whisperings that actually the ISA allowance were all going to go. And it didn't. It stayed at 20,000. But she has made the argument that actually if you're a bit younger, you can take the hit if your investments go up and down. Then when you're under 65, you're restricted into what you can put into cash. So you can only put 12,000 in a cash ISA. The other 8,000 of that 20,000 limit now has to be in stocks and shares. So that may make a difference. over 65, no difference at all. They understand that they might be more risk adverse. They might like the cash aspect. So I expect they'll be happy. And I don't really think there will be that much change in behaviour, to be honest. Most under 65s I speak to haven't got 20,000 to put in the bank account. So usually spent it on expensive cars.
Yeah. So in terms of the budget we just had, there was no real changes around capital allowances, capital gains tax, sorry. There was significant changes in the budget in October 24, but this graph just effectively shows how the tax take increase is going to go from 14 billion, it's going to more than double, projected to more than double to 30 billion. And that is purely off the back of kind of allowance freezes and asset price inflation. So when you sell an asset, it's worth more because of inflation. The Chancellor will collect more tax.
So the big one for me was business succession. A lot of people that have worked with me before may have been talking to me about what they want to do with their business in the future, whether they want to pass it down to kids, whether then they want to sell, do they want to do an MBO if they've got a good management team. There's a lot of fear that there might be problems there. When I spoke to Stephen about it, he said, what if they get rid of your business relief? You'll be absolutely screwed. You won't be able to do anything going forward. But luckily they didn't. So we've still got the business relief. So if you want to give shares to your children, you can still claim the holdover relief. So you can give that free of capital gains tax. And you can still get the inheritance tax relief from the business property relief and things like that, which we'll cover a bit more detail in some later slides. So that's all good. When we look at business sales, she made the big changes last year in the BADR, so the business asset disposal relief. So that's the one that replaced the previous entrepreneurs relief. And they forecast that actually that would go from what it is 14% now to 18% in April 2026. And that's still the case. So if you're going to sell your business, we're still very much as we were before the budget. The one she did change was the employee ownership trust. And this is the one that people always ask me about first when they're looking at selling, because it's completely free of capital gains tax. And everyone thinks that's wonderful, obviously. But it's not really the full picture, because actually what happens is on the next sale by your employees, they pay employment tax, income tax on the gain. So yes, there's no tax for you as the original sale to the EOT, but actually that tax is recouped through income tax later on. And that I think is an important point, because the reason she's made this change, so it's no longer completely tax-free, they now have 50% tax to pay. So you're looking at it as 18% BADR, and actually you're looking at 9% tax, it's still a good rate. But they've made this change because it's apparently 20 times the cost it was originally forecast to be by having this measure in place. So obviously people are using them. But I think they're only measuring that on the capital gains tax impact. Because actually, if they measured it with the income tax as well, for the employees on that second sale, I think actually they'd find they're recovering more revenue rather than less. So EOTs is not something we do a lot as a company. Quite often they are things that people want to talk about. But when we start talking about them, when we look at the actual qualifications for it and the difficulties that the company might have for trading going forward, they're not always the most practical. And I think this won't make a lot of changes for us and our clients, but I think for some businesses it will be a bit of a shame when they were hoping for no tax at all. The other thing they changed was an increased eligibility for enterprise management incentive. And this is something we do a lot of, because it's difficult to retain staff now. Anyone with a business will tell you it's difficult to retain staff, it's difficult to get staff in the first place. And a lot of people are using shares as a mechanism to bring people in and to keep them. So an extension of the EMI is really welcome. And essentially what they've done is just made the limits to qualify for that relief bigger. So it's now 500 employee, up to 500 employees, gross assets of up to 120 million. And you can now invest 6 million as the cap on the share options. So bigger companies it's really aimed at. So it's not just a smaller company's provision now, it goes to bigger companies as well, which can only really, I think, be welcome. They've also changed the holding period for the options from a 5-year to a 15-year. So that's hopefully encouraging more loyalty to firms. And I'm sure that's everything that we can all get on board with. They did mention UK listing relief. So this is really pushing the companies in the UK point. So you get a relief for 3 years from the date of the UK listing on stamp duty reserve tax. That's only 0.5%. But if it's a big number, then 0.5% of the big number is still a big number itself. So that could still be quite welcome. And it gives us another option there. One thing I didn't mention on EMI is Previously, an exit thing would be like a listing or a sale to a third party. And they've now brought in an exit event there for something called Pisces, which is effectively a platform for private shares. So that's making it more attractive to actually buy shares in private companies as much as listed shares. So again, that's all just pushing and pushing to encourage investment in the UK and businesses growing in the UK. The very last one on here is something that we had a little bit of a panic about in the office yesterday, I think it's fair to say. It wasn't in the budget, it was not mentioned, and it was not in any of the budget documents, but it did appear on the government website when they said we're changing the rules on share for share. So this is where you put holding company in. You might do that for completely commercial reasons, so you want to put your company premises in a holding company, keep it separate from your trading business. It's very normal. We have to apply for clearance, or we can apply for clearance, to say we are doing this for commercial purposes. And in every case I've ever applied for clearance, the answer is yes, that's absolutely fine, crack on. They've now said they're going to tighten the provisions, so if there's any tax avoidance for additional steps you might put in, particularly with family companies, is what it says in the guidance, then you won't get the clearance. But ultimately, the original scope of that clearance was, is there a tax avoidance motive? Is this mainly for tax avoidance? So although they have tightened the rules, there's a little bit of panic in the industry about it. I don't actually think it's changing. I think it's more of a guidance for their own staff to say, have you actually read this? Have you thought about whether there is tax avoidance? So I think some of the ones we've had clearance for, particularly on some of our family companies, I know one that we have, Joe, they probably shouldn't have given clearance in the first place. I think they were just giving it ad hoc. So I don't think there's anything to worry about there. I don't think there's really a huge change. So anyone who's looking at the long-term plans for the business, all those options are still open.
Again, in this budget on Wednesday, there wasn't a great deal of changes to inheritance tax. So the allowances are frozen, the breaks haven't changed. But what I'm just trying to demonstrate here is effectively she's hoping to raise double the amount of receipts from inheritance tax to the end of this parliament. So from around 7 billion to around 14 billion. And that's going to bring, at the minute, about 5% of the states pay inheritance tax. That's looking to increase to about 10% of all the states when you die. So inheritance tax is going to become an increasing issue for more and more kind of, especially in this region, a reasonable house, some money in a pension pot and some savings. A married couple will soon exceed that £1 million threshold. So, yeah, but this is largely from changes that were in the October 24 budget rather than in the budget this week.
So, as Stephen alluded to, and the reason for those big increases are those two big changes, the BPR, APR change from April 2026 and the pension inclusion from April 27. So they're not in yet. They are still coming. There was an awful lot of lobbying about both of these provisions. Some of them actually both of them, to be fair, on practicality reasons. The pensions in particular, it felt that she hadn't really thought through how are you actually going to do this? Isn't this going to make a huge impact on estates and the probate process? So what we really wanted, or what I wanted personally, was a bit of fairness, a bit of simplicity. So the residence nil rate ban to be abolished. This is that 175,000 that adds to the 325,000, but it's not available for everyone. So there's unfairness between cohabitees and married couples. There's unfairness between people that have kids and don't have kids. So a little bit of fairness, a little bit of simplicity, rather than two bans. Let's just have one nil rate ban, one 500,000. For me, that made a lot of sense. I'd also like to see that APR, BPR increased, I think, as everyone would. There was lobbying for 3 million or 5 million. We love an acronym, an accountancy firm. It's a residence nil rate band. So your nil rate band is your 325,000, and the residence one is the 175,000 for passing on residence, but maybe not on residence, because that would be too simple, onto children if you have them. Agricultural property relief and business property relief is the other ones with the 100% limit. Like I said, they were lobbying for those to be increased, and we wanted those to be increased because it took out more businesses. $1 million isn't really that much for most businesses, so that would have been quite helpful in just making the burden a little bit less. And also the fact that the agricultural property relief and the business property relief couldn't be passed to a spouse, it's just awkward. So most people will leave the assets to the spouse and then down to kids. can't we do that? Can't we just pass the allowance like we do for the nil rate band and the residence nil rate band? So simplicity, making it easier, just taking the burden a little bit lighter. I'd personally prefer to have seen pensions just removed from this, but I thought that was a bit overambitious. And it was overambitious, to be fair, because this is what we actually got. We've got the nil rate band and the residence nil rate band still there and frozen. So those lines that Stephen showed us in the graph before, they're definitely coming in because the value of assets is going to go up and the value of allowances is not. They didn't change that 1 million at all, which is very sad. They did allow it to transfer to spouses, so a little bit of a concession, but for me, not really enough. On the pension side of things, the administration was difficult. No one was going to ever want to be a personal representative because you could be liable years down the line for a pension you didn't know anything about. There was arguments over who's going to collect this tax. Is it the pensions people? Is it the PRs? And I said, well, actually, it's a bit hard for the pension people. We'll put it all on the PRs. And the PRs said, well, no, I don't want to do it because now I'm completely liable. So if you have a friend and you are their executor, you'd be absolutely not. I don't want to be your executor. This is too much hassle for me. So they brought in a little bit of a relief, I suppose, for them. So they've said to the pension providers, you keep 50% of the taxable pot for up to 15 months. So we've got a cut-off point. And that's important because otherwise it could go on, estates could go on for years. They said to the personal representatives, the executors, that actually you can apply for HMRC clearance. And once you get that clearance, if there is a savings account, if there's a pension that comes out the woodwork, you're not liable. We've given you clearance. And that's just going to give people a lot of comfort. It's not the perfect solution, but it is a solution. So it's another example of where maybe the Chancellor didn't necessarily think about the practicalities of some of the measures. She put in a brilliant idea, and she's just fudging around the edges to try and get it to fit in practice. There was a bit of a surprise in that there was an exemption for the payments in relation to the infected blood compensation scheme. That has been lobbied by a lot of lawyers for a long time, so actually they're quite happy with that. And that's always a welcome exemption. And then I think I've included this one just really to show you what the impact is on the non-dom regime. So an excluded property trust is a trust that's set up offshore by a person who is offshore. And the changes that came in October last year brought a lot of those within the charge to UK tax, even though they've been outside of UK tax for years and were never expected to be within UK tax. And to give you an example of how much revenue she thinks she's raising from these, she's capped the tax on these that are now in the UK tax net to 5 million. So there's hopefully, I think this is the only measure I've seen which could potentially fill that black hole if she's right on her forecast of what she thinks they're bringing in. So national insurance, we've already had the big fun and games of national insurance, so there wasn't much in that one. In fact, the only really interesting one was the change in the voluntary class 2. So by all accounts, you could go abroad and pay voluntary class 2 to top up your UK state pension entitlement and then receive it abroad much cheaper than you could in the UK. That seems quite unfair. They've blocked that. So that's a very welcome change. They've also got a restriction on how many years you need to effectively have been making contributions in the UK before you kind of qualify for the voluntary ones. So all of that's taking advantage of the welfare system, I think I would say, and trying to crack down on those type of things.
So then in terms of pensions, in the lead up to this budget, there were plenty quite noise about potential capping of income tax relief on pensions. That it's worthwhile just to say there were no real changes to pensions other than the salary sacrifice changes. So pensions do remain a really powerful tool in tax planning terms, but profit extraction from your business. So the annual allowance of 60,000 remains the same. The lifetime allowance that was abolished in April 24 is still abolished. You'll still get full marginal rate tax relief on your contribution, and you'll still get full corporation tax relief on any company contributions. And she didn't touch the tax-free lump sum on or pension commencement lump sum. So that's still, you can still draw a maximum 286,000 from your pension. So they're still really powerful. They're not so good at all for estate planning, where they're now being brought into the scope of inheritance tax. But they're still very powerful. And from the planning point, if you are in salary sacrifice, you might look to maximize your contributions prior to the change that will be brought in April 2029.
So we're going to go a bit quicker now, so I'm conscious of the time. Just other couple of taxes they brought in. They always bring in what we call the sin taxes. So you can't get your latte in a can from Tesco's anymore without paying extra tax on that. The most welcome, I think, one for me is the loan charge. That has been a retrospective tax measure, although the government would say it's not. It has been, and it's been very difficult for a lot of people. They've got to the point now where if those people can't pay, they're going to look at a different settlement. And realistically, they can't pay. They've bankrupted lots of people. So I think that's a welcome change. The other one, which is a big one for me, is the online gambling. So we have, I see a number of clients, we're looking at inheritance tax planning, and there are a number of people actually in the UK that have addictions to online gambling. We put in a lot of trusts and things to help with those people that are suffering with that. But actually the government are trying to take steps to make that more difficult for those platforms as well. So they've increased the remote gaming duty. So that's gone from 21% to 40%. That'll be from April 2026. But it won't be on horse racing or for gambling in person. So that's still seen as more of a sociable thing. And that's maybe not so harmful. It's contributing to society rather than just harming certain individuals. And importantly, they've made an exemption for bingo duty. So my nan's delighted that actually she'll be able to go to the bingo hall from April 2026 and her bingo will be exempt from gaming duty.
But we can't do two-bet ladies.
But, oh, yeah, you're not to say that anymore. We did actually check that, to be fair. So the last one is the non-taxes. So this is a council tax, but it's not a council tax. So this is the high value property surcharge. That's what they're calling it. And it only applies for people who have a house worth more than 2 million. And at that point, from April 2028, you will pay £2,500 per year with your council tax to your local authority for the pleasure of having that house of that size. And then that will gradually increase as your house goes up to 5 million. If your house is 5 million or 10 million or anything above 5 million, you're looking at £7,500 a year. It's a form of wealth tax. Let's not dress it up. But it's very similar to what we have as ATED, which is the annual tax on envelope dwellings. And this is what they brought in where people had a property inside a company. And it started off at 10 million. And everyone went, that's not a problem. That's really high. And then it started dropping and then it started dropping. And that one is now at 500,000. And as we were talking about with the values on the South Coast, if this one drops as well, 500,000 would bring an awful lot of people on the South Coast within this particular charge. So yes, it might seem like a big one at the moment. Is it going to get worse? Is it going to come in more aggressively as we go along this parliament? But I think the big one is the practicalities, like how are you going to value these properties? Who's valuing them? Are we sending around estate agents? Are we looking on the Google Maps? Like, how are we doing that? So for ATED, we have to revalue every 5 years and we take a historic value and use that. But is this going to encourage people to change their behaviours? Are people going to pause on putting an extension on because they want it to just go past that 5 year before they put their property value up? And what about sort of state of repair, things like that? So there's a lot of practicalities with this, which she hasn't addressed. They're definitely not in the budget documents. And I think it'd be interesting to see how those come across. So I think that the wrap-up conclusion of this is there were a few measures in the budget. It wasn't really, really exciting for us as tax professionals. And actually, it's still given us a lot of planning opportunities. There's actually more with income tax now, with the change in rates. And there's still income tax and CGT at different rates. There's still some planning we can do there. Corporation tax is still lower than income tax, so we can still look at things like incorporating property portfolios is still an attractive thing. We can still use family investment companies, and those are really, really popular at the moment. And people are always banding this around like it's a different type of company, but it's just a company with family shareholders. That's all it is. But quite often those shares are different classes. So you might have, if we had a sort of tax family company, we might have A, B, C, D shares. And that means if Stephen's done really well this year, we can give him 10,000. Sorry, Alan, to pick on you, but you might not get anything this year because you've had a bad year. It gives you that flexibility. So there's still something we can use and we still will be using going forward. Like I said earlier, we'd still use lifetime gifts. And pensions are still attractive. They still give you corporation tax relief. You still get your salary sacrifice up till April 29. And you can still do your tax-free lump sum drawdown. So there's still an appeal in them, particularly for the younger generation, but maybe less so for the older generation where they're now exposed to inheritance tax. So a question for you all. Did she keep her promises? So the manifesto said Labour will not increase taxes on working people, which is why we will not increase national insurance, the basic hire, or additional rates of income tax or VAT. So, did she change the income tax thresholds, Joe?
Surely no.
National insurance, Stephen?
Not employer E.
VAT, Alan?
No.
But does that mean taxes didn't go up then? And I think I'm hopeful that if nothing else that we've taught you today, fiscal drag, I think, is the word. So I think in theory she did keep her promises. In practice, it's a bit of a grey area, as we like to have. It depends, is what we like to say in the tax world. But the good news is we've only got one budget a year, so we don't have to go through all these new measures and all these changes twice, which is good. And as Stephen alluded to earlier, and as Joe alluded to as well, a lot of these changes are coming in a long way down the line. And actually, we've got a black hole now. So are they going to fill the black hole? And are they actually going to come in? And we're going to get a change in government in 2029. And that's it. They all change again. So it's a interesting one, I think, I would say. Strange one, I suppose. But otherwise, thank you all very much for attending. And thank you for your attention.